Hey guys, today we are going to learn net present value. This is the third part of our capital budgeting video. So if you have not watched that video yet, I will suggest that go and watch that video first and then move to this video. I will give you the link of that video in the description box and in the icon here. So let's move to net present value. The formula of calculation of NPV is present value of cash inflow minus present value of cash outflow. This is a simple formula, isn't it? And on the basis of this formula, you can also make the definition of net present value that says that NPV is the difference between the sum of all present value of cash inflow and sum of all present value of cash outflow. And same, the formula says that NPV is the difference between the present value of cash inflow and present value of cash outflow. Later on, try, we will do the question of NPV and try to understand that where do we actually use NPV in the real situation. Now we'll move to that where does the company use the NPV method in real life or in real situation, you can say. As the finance manager of your company, if you have to decide whether to buy a machine or not, or you have to decide between two or three machines that which machine you should buy, then you will use NPV method. What does it mean? Actually, the company use NPV method when it has to decide whether to buy in a machine, whether to buy a machine or not, or whether to invest in a project or not. The same thing it is written here that when the company has to decide whether to invest in a project or not, or when it has to make decisions between two or more projects, that for which project should the company go for. For that example, suppose ABC company needs a machinery for production purpose. You can see this machine and company has this machine proposal for the production purpose. Now, whether to buy this machine or not will depend on the NPV. So the company first will calculate the NPV of this machine. Later on, we will learn how to calculate NPV. But for now, suppose the company calculate NPV, and if NPV is positive, the company will buy this machine, and if NPV is negative, the company will reject this machine and would buy another machine. So there NPV is used. And in another situation, suppose our company has more than one machine's proposal, machine A, machine B, and machine C. And now we have three machines proposals and our company wants to buy only one machine. Then which machine our company should buy? Either machine A or machine B or machine C. How will company choose? Company choose on the basis of NPV method. Whose NPV will be higher, company will buy that machine. Suppose machine A NPV is 8, machine B NPV is 5, and machine C NPV is 10. Because machine C NPV is higher in all that machines, machine A, machine B, and machine C. So we will buy machine C because machine C NPV is higher above these machines. And the same thing it is written in the accept and reject criteria of NPV that if company has only one machine proposal, then in that case, if NPV is positive, we would accept the proposal to buy the machine. And if NPV is negative, we would reject the proposal. Similarly, if the company has to decide between two or more machines proposals, then the machines having higher NPV would be chosen, and if NPV is 0, the firm would be indifferent between accept and rejection of the machine. Means if NPV comes 0, company could buy the machine and company could not buy the machine. It will be depend on the will of the machine. So this is known as accept and reject criteria of NPV. Means if NPV is positive, we will buy the machine, and if NPV is negative, we won't buy the machine. Similarly, if we have more than one machine's proposals, we would buy that machine whichever NPV is higher. Because machine C NPV is higher here, we would buy machine C. So let's move to a question of NPV now. This is the question of NPV that says that ABC Limited is planning to buy a machinery of rupees 1 lakh. The machine will give the profits before depreciation and tax or for next 5 years that are as follows. For next 5 years means that the machine's life is 5 years. In the first year, the machine will give 30,000 rupees profit. Similarly, in the second year, it is 35,000, and the third, fourth, and the fifth year. Now, the company uses SLM method of depreciation. SLM method means straight line method. Rate of return is 10%. Using NPV method, give you advice whether to buy the machine or not. Because here we have to decide whether to buy this machine or not. So we will use NPV method. Now, because we know the formula of calculation of NPV is present value of cash inflow minus present value of cash outflow. So let's find out first of all present value of cash outflow. That is so simple because present value of cash outflow is always equal to the cost of our machinery or cost of our project. Because this amount we are expanding in the beginning of year. As we are expanding it in the beginning of year, it is same as present value of cash outflow. So we already have present value of cash outflow. We can write it here like present value of cash outflow is equals to 1 lakh, because present value of cash outflow is always equals to the cost of our machine and project. Now later on, let's calculate present value of cash inflow. Till now we have calculated present value of cash outflow, that is already given to us. Now we will find present value of cash inflow. As we know, we have profits here because profits are given. These profits are before depreciation and tax. It is written here. You can see that this profit that is given from first to fifth year is before depreciation and tax. So we cannot directly calculate present value of these profits, as we don't need present value of profits, but we need present value of cash inflow. Because NPV formula says we need present value of cash inflow, we don't need present value of profits. So first of all, we will have to calculate the cash inflows. We don't have cash inflows in this question. We only have profits that is given in this question. It is already mentioned. Please remember that it is already mentioned in the question that these are not profits. I mean that these are not cash flows, but these are only profits that are before depreciation and tax. So first of all, what we will do, we will calculate the cash inflows of first to fifth year, because we know our life of machine is 5 years. That is mentioned here that this profits would be for next 5 years. So let's calculate first of all present cash inflows. We know cash inflows are not equals to profit, and we already explained it in the previous video. I will also explain here. So let's watch out. Actually, the profits that is given here are before depreciation and tax. That is also known as earning before depreciation and tax and tax. That is equals to the EBDT. EBDT means earning before depreciation and tax. Suppose these profits are any value, let's XX. First, we are learning here how to calculate cash inflows out of profits. So these are the procedures that you need to follow to calculate cash inflows out of profits. If profits are given, suppose these are the profits that is given, then first of all, our first step would be to deduct depreciation out of it. So our first step would be to deduct depreciation. So let's depreciation amount is XX. So first of all, what we will do to is to deduct depreciation. After that, we would have some amount after deduction of depreciation after profits. This amount is known as profit after depreciation, or profit profit before. You can say it is profit before tax. Its dual name here, first name is profit after depreciation and the second name is profit before tax. This amount that comes after deduction depreciation after profits. Now, out of this amount, because this is our taxable income, always remember profits after depreciation or profit before tax, it is taxable income, and on this income we calculate the tax. So our second step would be to deduct the tax amount or tax rate. So our second step is to deduct tax. Now suppose tax rate is you can take any percentage, for example, and the amount is XX. After deduction of tax out of profit after depreciation or profit before tax, we would have profit after tax. Remember, this amount is profit before tax, and after deduction tax we would have profit after tax. Let's suppose it would come XX. Let's highlight it here by underline. This is the amount after deduction of tax. That's called profit after tax. Now, after deducting tax, the next step would be add again the depreciation. So why we are adding depreciation again is that because depreciation is a non-cash expense. We are not paying depreciation to any third party, and therefore depreciation is not any cash outflow because it doesn't involve any cash outflow. So we have to add it again to get cash flow after tax. So again add depreciation in profit after tax. Let's suppose it is XX. After that we would have cash flow after tax, and this amount, and this is what we need to find out present value of cash inflow. This is what we need. So let me highlight it here that this amount is we need to find out NPV, because in this question profits are before depreciation and tax is given. Profits before depreciation and tax, that's also known as earning before depreciation and tax. So we have to find out cash flow after tax because we need present value of cash flow after tax in the question. As we know, the formula of calculation of NPV is present value of cash inflow minus present value of cash outflow. So here we have learned how to calculate cash flow after tax. Let me remind you that first of all, we would deduct depreciation after profit before depreciation and tax. After that, we would have profit after depreciation or profit before tax. This is profit before after depreciation. After that, as it is taxable income, we deduct tax amount, then this is a tax amount, then after that we would have profit after tax. This is profit after tax. After deducting tax, we would have profit after tax, and after that we would add depreciation again because it is a non-cash expense. So after adding depreciation in profit after tax, we would have cash flow after tax, and this is what we need to find out NPV. So to find out cash flow after tax in the given question, we will make a table. So let's make a table here. We will make a table of 6 by 9. So 1, 2, 3, 4, 5, 6, and 1, 2, 3, 4, 5, 6, 7, 8, and 9. So let me big it. I think it's enough. So in the first column we would write years. In the second column we will have profits before depreciation and tax, that is also known as ABDT. ABDT means earning before depreciation and tax. So earning before depreciation and tax. The third column we would deduct depreciation, as I have already told you. So deduct depreciation. After deduction depreciation, we would have profits after depreciation. So profits after depreciation. PAD means profits after depreciation. After deduction profit depreciation, PAD is also known as taxable income. So we'll deduct tax. So write down tax here. Then deduction tax, we would have profits after tax. So profit after tax. After profit after tax, we have to add depreciation again because it is non-cash expense. Then we would have cash flow after tax because we would add depreciation in profit after tax. So we don't need to make depreciation column again because we have already make it here. So directly write down here cash flow after tax. Then in the next column, we would calculate present value factor. PVF means present value factor. Then we will have present value. Later on, we will learn how to calculate present value factor and present value. But first of all, let's calculate cash flow after tax through EBDT, that is given in the question. Because our machinery life is 5 years, so we will write in years 5 from 1 to 5. First year, second year, third year, fourth year, and the last 5th year. EBDT is given in the first year is 30,000. in the second year it is 35, in the third year is 40,000, and similarly fourth year 45,000 and fifth year is 50,000. So write down here, in the first is 30,000, in the second year it is 35,000, and the fourth is 40,000. It is increasing by 5,000. So in the second year is 35,000. So write down 35,000. In the third year it is 40,000, as it is increasing by 5,000 in each year. In the fourth is 45,000. The profit is given in the question, and the last year is 50,000. That is already given in this question here. So in the second step we have to calculate depreciation, but remind that we don't have any depreciation rate. It's given in this question. The rate of return rate is given, but this is not our depreciation rate. So how to calculate depreciation? We can calculate depreciation because the company use SLM method. So when the company use SLM method of depreciation, we have a formula to calculate depreciation that I'm sure you must know. That is said that SLM of depreciation is equals to cost minus salvage value of your machine divided by number of years. So through this formula we can calculate depreciation, but remember this depreciation is only applicable when company use SLM method of depreciation. Because it is given that company use SLM method, we can use this formula to calculate depreciation. Because we don't have salvage value in this question, you can say that we don't have any salvage value, so we can directly divide cost by number of years. Number of years means life of our machinery. And we know that in SLM our depreciation remains equal in each year. So our cost of our machinery is rupees 1 lakh. So write down here 1 lakh minus salvage value. As salvage value is not given in the question, we will take it as a nil. Now divide by number of years. Number of years means life of your machinery. So our life of our machinery is 5 years. So divided by 5. So when we will divide 1 lakh by 5, we get 20,000 rupees. So this is our depreciation by using simple formula. Because company use SLM method of depreciation, and we know that when company use SLM method of depreciation, then depreciation, this amount remains same in each year. Mean first year depreciation would be 20,000, second year would be 20,000, similarly till the fifth year depreciation amount would be 20,000. So write depreciation amount in this column, 20,000 rupees, and in each year it would remain 20,000 rupees. In the third year 20,000, in the fourth year it is 20,000, and the fifth year it is also 20,000 rupees. Now our third step would be to deduct depreciation out of EBIT. So after 30,000 minus 20,000 would be 10,000. It is 15,000. It would be 20,000. It would be 25,000. And in the last it would be 30,000. Now as I have already told you that PAD means profit after depreciation or profit before tax is taxable income. So now we will calculate the tax rate. Because tax rate is not mentioned, actually it is given in the question. So just write down here that tax rate is at the rate of 40%. Suppose tax rate is at the rate of 40%. So now we will calculate tax on PAD means profit after depreciation at the rate of 40%. So 10,000 of 40% is 4,000 rupees. We are calculating tax, remember, at the rate of 40% that we assume in the question. That is 40%. That would be remain in the question when you will do it. So 15,000, 40% is 6,000 rupees. You can calculate. 20,000, 4% is 8,000 rupees. And 25,000, 40% is 10,000. And the last 30,000, 4% would be 12,000. Now, after calculating tax, we have to deduct tax after profit after depreciation to calculate profit after tax. So 10,000 minus 4,000 is equals to 6,000. Similarly, deduct 15,000 minus 6,000, that is 9,000. Now 20,000 minus 8,000 is 12,000. Similarly, it is 15,000. And the last 30,000 minus 12,000, it is 18,000. Now, what do we do next to get cash flow after tax? I have already told you that after profit after tax we have to add depreciation again in profit after tax to get cash flow after tax. So what we do here, we again add profit after depreciation in profit after tax. So we add this depreciation in this profit after tax to get cash flow after tax, because depreciation is a non-cash expense. So do one thing, add profit after tax in depreciation. So when you add 20,000 here depreciation in profit after tax in 6,000, we would have 26,000 in cash flow after tax. Second thing, 20,000 plus 9,000, so it would be 29,000. Third, 20,000 plus 12,000, so that would be 32,000. Next, 20,000 plus 15,000, that is 35,000. And similarly in the last year, that is 38,000, when you will add 20,000 plus 18,000. Now we have cash flow after tax, and what do we do is we need to find out present value of cash inflow. We have got cash flow after tax. Now our requirement is to get present value of all this cash flow after tax of each year. So for that, we have to calculate present value factor to get present value of cash flow after tax. So how to get present value factor? We have a formula to get present value factor of each year. That formula says that present value factor is equals to 1 divided by 1 plus R, brackets close here, 1 plus R is to the power n. What is R here? R is our rate of return and n is number of year. So our rate of return is given, that is 10%. You can see here that our rate of return is 10%. So our R is here 10%, because R is 10 for its rate of return, and similarly n is 10 for number of years. If we are calculating present value factor of first year, then n would be 1. If we are calculating present value factor of second year, so n would be 2. So simply if we could calculate present value factor of each year, like if we are calculating present value factor PVF of first year, that would be 1 divided by 1 plus R, that is 0.1. 0.1 means 10%. You can write it in decimal here. It's to the power n, because n is first year, so we write down 1 because we are calculating present value factor of first year. So when you calculate it, its value would be 0.909. We always remember we take present value factor after the 3 points of decimal. If it come 5 places after decimal, then we would only take till 3 places of decimal in present value factor. Actually, we have a short trick to calculate present value factor of each year through our simple calculator. So we won't calculate it one by one, but we calculate it through using simple calculator that you have in your normal life. So simply we will calculate present value factor on the calculator. For that, I am just opening my calculator. Now, because we know that our formula to calculate present value factor is 1 upon 1 plus R is to the power n. So what we will do, because we first of all write down 1, now plus your R. Our R is 0.1. So 0.1 is equals to 1.1. Because 1 plus R is 1.1, because our rate of return is 0.1. Now we have get 1.1. Now simply you need to do, just press divide. button in your simple calculator, press divide button and is equals to. When you press is equals to, you will simply get your present value factor, that is 0.9090909 and so on. But I have already told you that take only 3 places decimal. After decimal, take 3 places of points. So I have take only 909. Now if you want present value factor of second year, simply press equals to again. Now don't press divide button or divide option again, just simply press equals to again. So this is our present value factor of second year. Simply press equals to third year third time to get present value factor of third year, that is 0.75. Now to get present value factor of fourth year, simply press equals to fourth time again. Now 0.683. Now to get the fifth year, simply press equals to once again. This is the present value factor of fifth year. I'm doing it once again for you. That let me open it again, calculator. Now first of all, 1 plus 0.1. 0.1 why? Because our rate of return is 10%. So we have 1.1, sorry, 1 plus 0.1, that is 1.1. Now simply press divide option here, simply press divide one time only. Now press is equals to. As you press is equals to after divide, then you will have the present value factor of your first year, that is 0.90909. Now if you want to get present value factor of your second year, simply press is equals to again. When you press is equals to again, you would have present value factor of your second year. Now press is equals to again. This is the present value factor of your third year. Now press is equals to again. This is the present value factor of your fourth year. And now simply press is equals to again. This is the present value factor of your fifth year. So this is a short trick to find present value factor of each year to save your time. So we'll simply write down present value factor of each year through here. So first year is 0.909, that I have already written down here. Second year is 0.8264. So our second year present value factor is, first year is 0.909. Second year is 0.826. Now third year is, our third year is this 0.751. Our third year is 0.751. Our fourth year is 0.68301. We will take only 3 places, so 0.683. So 0.683. Now again in the last year, our present value factor is 0.6209, because after third place of decimal, the fourth term is bigger than 5. So our 620 will become 621. 0.621. Now we have got present value factor. Now to get present value of each year that we need to calculate NPV, simply multiply your present value factor by cash flow after tax of each year one by one. So when you multiply 20,000 multiply by 0.909, what we will get? Let's calculate here. That when we multiply our 26,000 by 0.909, we get 23,634. So write down here 23,634. Similarly, multiply 29,000 by 0.826. When you multiply it, you will get 23,954. Similarly, in the next year, 32,000 multiplied by 0.751, you will get 24,032. In the fifth year, you will get 23,905, and in the last year, similarly, when you multiply 38,000 by 0.621, you will get 23,598. So now we have get present value of each year from the first year till the last fifth year. Now, to get your total present value factor of your cash inflow, because we need present value factor of cash inflow, sum of all cash, as if we see the definition, it says that we need sum of all present value of cash inflow. Sum of all present value of cash inflow. So we have now present value of each year. Now our next step would be to do the total of all these 5 years present value to get present value, to get sum of all present value of cash inflow. So simply total here, when we total it of each year, we will get 1,19,123. After adding all present values of fifth year, we will get 1,19,123. Now we have present value of cash inflow as well present value of cash outflow, that is 1 lakh. So now we have both present value of cash inflow as well as present value of cash outflow. So we can simply calculate present NPV here. So NPV is equals to 1,19,000, that is our present value of cash inflow, that is here, that 1,19,123 minus present value of cash outflow, that is 1 lakh. So when it deduct 1 lakh, we will get positive amount, that is 19,123. When you deduct 1,19,123 minus 1 lakh, you will get 19,123, which is positive. So always write down which is positive. You have to mention it in your question, in the answer. So the company can, or you can say may, buy the machine. I have already told you, always remember, whenever NPV is positive, company will buy the machine. If NPV comes negative, we won't buy the machine. So our NPV is positive, we can buy the machine. Let me remind you that what all we have done till now. First of all, we have calculated cash flow after tax, because we have to calculate present value of cash flow after tax, not of EBDT, that is earning before depreciation and tax. So first of all, we have calculated cash flow after tax. After calculating cash flow after tax through this procedure of each year, we just repeat this procedure of each year. First year we repeat, second year, similarly we have repeated from first to fifth year. Then we calculate present value factor, that I have explained you through the calculator. You can do it by your simple calculator at your home. Then we calculate present value by multiplying cash flow after tax by present value factor. Then we get present value. In the final, we add all these present values to get present. We all total it present value to get present value of cash inflow. After that, we calculate NPV by deducting present value of cash inflow minus present value of cash outflow. That comes positive, so the company may buy this machine. Now, similarly, if the company would have more than one machine option, in this case like machine A, machine B, machine C. Suppose our company would have 3 machines option, machine A, machine B, machine C, and of each machine we have our cost and inflows. In that case, what would you do? You will calculate NPV of each machine separately. First of all, you will calculate NPV of machine A through the same procedure like we have done it in this video. Similarly, you will calculate NPV of second machine, that is machine B, and similarly you will calculate NPV of your machine C. And then finally you will see which machine has higher NPV. Whichever machine would have higher NPV, you will buy that machine only. Similarly, in this case, that machine C in this question has a higher NPV, so we will buy machine C. We have buy machine C in this video. We have buy machine C because of its higher NPV. So suppose if this question would be 3 machines, machine A, machine B, machine B, then simply don't need to do nothing extra, but you will have to calculate NPV of each machine separately like we have calculated it here. So this is all for today. You will again solve replacement of machinery in the next video. How to solve replacement of machinery. Always remember that NPV and replacement of machinery is an important question that always comes in your exam. So please practice it, and if you have any doubt, please comment it. I will try as soon as give the reply of that comment. So thank you guys for watching that video.